Welcome. This is Kathleen Levito, and I'll be your host for today's webinar entitled What Are Mortgage Pines and Why Pay Them? Joining me today is Rick Means, Inside Sales Call Center Manager for AAFMAA Mortgage Services. If you have any questions during the presentation, please enter them into the question block on your screen. This monthly webinar series is brought to you by AAFMAA Mortgage Services LLC. We are a wholly owned subsidiary of AAFMAA, offering a full spectrum of mortgage products to the military community. Currently, we conduct business in Alabama, Colorado, Connecticut, Delaware, Florida, Indiana, Iowa, Kansas, Kentucky, Maryland, North Carolina, Oklahoma, Oregon, Pennsylvania, Rhode Island, Tennessee, and Virginia, and will continue to open offices in states across the country. The AAFMAA Mortgage Services team consists of state licensed loan officers. Among all of our professionals, we have decades of both military and industry experience. We are an equal housing opportunity lender, and for your record, our NMLS is 1423968. As a wholly owned subsidiary of AAFMAA, we operate with the same values and priorities of our parent company. AAFMAA stands for American Armed Forces Mutual Aid Association, and is a longest-standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of financial planning, investment management, and trust services for the military, not-for-profit. This presentation is educational. It's for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your home purchase decision. Since each individual situation is unique, the type of loan that benefits you the most will not necessarily be the same as another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources available to them. I will now go ahead and turn it over to Rick, who will begin the agenda.
Thanks, Kathleen. Good afternoon, everybody. So on our webinar today, we're going to cover a couple topics. First of all, I'm going to go over who AAFMAA Mortgage Services is. Then we're going to talk about what a point is. It's actually a commonly misunderstood term, and then why they exist, how you know if you should pay them, and then finally, what par plus pricing is. Now, first of all, AAFMAA Mortgage Services' mission is to be the premier provider of mortgage services to the American Armed Forces community. And as part of the military community, we want to make sure that you are well informed and taken care of at every step of the lending process. Plus, being part of the longest standing not-for-profit member-owned association, it enables us to offer low rate and low cost mortgages to service members and veterans. Now, what is a point? Well, in its most basic term, 1 point is equal to 1% of the loan amount. So for example, if you have a $200,000 loan, 1 point is equal to $2,000. And a point is interest that is paid up front in exchange for lowering the interest rate. And rates of points, quotes are typically quoted in 1/8% increments. So they're also known as loan discount points, and they are prepaid finance charges that are paid up front to allow for a discounted rate for a period of time. And the period of time is however long your mortgage is typically. They result in lower mortgage payments because obviously a lower interest rate gives you a lower payment. They may offer some tax benefits, but make sure to contact a tax advisor for the benefits. On purchase transactions, they allow the borrower or the buyer to qualify for a more expensive home. And on refinance transactions, they may lower the borrower's housing expense. They also do so on a purchase transaction, for the same priced home. If you're getting a lower interest rate on the purchase, obviously your mortgage payment's going to be lower too. Now, the general rule of thumb is that if you pay 1 point up front, it reduces the rate by 1/4%, or a 1/2 point reduces it by 1/8%. So for example, if you have a $200,000 loan, $2,000 in points, or 1 point, reduces the interest by 0.25%, or 1/4% per year. And that equates to roughly $500 a year. Now, it's not exact because the interest is charged on a declining balance over time. But for example's sake, it's close enough. So for the simple math, you would take the 1% up front and divide it by the 1/4% per year, and you get roughly 4 years, plus or minus, time to recoup the savings, the interest savings. So an important question to answer is, how long do you anticipate staying in the home? And that really is the key determining factor as to whether or not you want to go ahead and pay the points. So an example, typical example. So let's say you have a $200,000 30-year fixed rate mortgage. At 4.25%, paying no points, your principal and interest would be $983.88 per month. Now compare that to paying 1 point and buying your rate down to 4% over that same 30-year period. Now your principal and interest payment is $954.83. So the monthly savings on this is, the math, 983 minus the 954 gives you a $29 a month savings. So over the life of the loan, which is 360 payments, you save $10,458 for that $2,000 up front. So this sounds like a really good deal, and a lot of people would say, well, why wouldn't I do that? Okay, that's a ton of savings over the life of the loan. Well, one of the reasons why you wouldn't want to pay points is, even though you may be in the house for 30 years, which is not, it's not a common occurrence right now. But the important thing is the average American has the loan for 5 to 7 years. And there are several reasons for this, but the savings that I mentioned before assumes that you make the payments for the full 30 years. But you have job transfers, you have refinances to lower rates. So, if you're in the loan for 3 years, the rates drop and you refinance it, well, you've paid points up front, and now you've refinanced the loan and paid off the loan, starting over. Or refinances to take cash out of your equity to do home improvements or debt consolidation, et cetera, et cetera. Divorce, or upsizing or downsize. There are numerous reasons why the average American is in the loan for 5 to 7 years, and they take that into account in pricing the loans and determining points. So let's do a comparison. So after 4 years of the remaining principal balance on that previous example at 4% is $185,027. But at the 4.25%, since you have a higher interest rate, less of your payment is going towards the principal in the early stages of the loan. So that's why after 4 years, you have $185,611 remaining. So not only do you have the savings due to the payment, the monthly payment at the $29 a month times 48, that's $1,394.40. You also have savings due to the difference in the principal curtailment, which is $584. So if you combine the two of those, after 4 years, you've saved $1,978 between the two, at an upfront cost of $2,000. Now, after 5 years, the savings due to the principal curtailment is $710, and the savings due to the payment is $1,743. So now that $2,000 up front has saved you $2,453. So really, with that rule of thumb of 1 point giving you a 0.25% reduction, your break-even point is just over 4 years. Now, the previous example was on a 30-year fixed. This one's on a 15-year fixed. And we're going to change the interest rate a little bit just to, to vary the dynamics. So on a 15-year comparison, we're comparing 5.25% versus 5%. Here, after 4 years, you see the differences in the principal balances between 5% and 5.25%. So now the savings due to principal curtailment is $626 after 4 years. Due to payment is $1,248. So the total savings on the 15-year after 4 years is $1,874. After 5 years, savings due to principal curtailment is $735. Due to the payment savings is $1,560. Total savings $2,295. So here the break-even point is about 4.5 years. And what you see is on the lower the term of the mortgage, the less incentive there is to pay points, especially with that rule of thumb where 1 point gets you 0.25% reduction in rate, because it takes a longer time to recoup that savings. Now, one other thing to consider is, while it's possible to pay or buy the rate down, you can also do the inverse and buy the rate up. So when you buy the rate down, you are paying a point to get a lower interest rate. When you're not buying the rate down, your rate is what's called par, and par means the rate with no points. So in our example, 5.25% is the par rate at the 15-year. And as you've learned, you can pay points to get a discounted rate, but we're doing the reverse. So when you go with the rate that's above par, or in this case, say 5.5%, you can typically get a lender credit in exchange for paying above market rate. So this is called par plus pricing, and that lender credit is used to reduce your closing costs. It's a credit that's given towards your closing costs. So the analysis in all of this, okay, so you've got the simple math version. The points that you pay divided by the rate discount equals the approximate time to recoup the cost. The longer you are going to be in the loan, the more it makes sense to pay points. So like in our previous example, if you were in a job that typically gives you a transfer every 3 years, then you're probably not going to want to pay points on the loan, because in 3 years you're going to need to sell the house. Or the shorter the term, the longer it takes to recoup the cost of the buy down. So, for example, if you were doing a 15-year mortgage and it was going to cost you a point to buy the rate down 0.25%, probably wouldn't make sense to do that because of the time it takes you to recoup it. If you anticipate rates to increase in the long term, then you want to give greater consideration to paying points. If you believe rates are projected to go down in the long term, paying points lessens the likelihood of refinancing, because you're investing a bunch of money up front, and if the market shifts, you're going to have to invest that same amount of money to get a comparable rate reduction as you would if you weren't paying points or even doing par plus pricing up front, and the market goes down, then theoretically you'd be able to do the same thing on down the line. So it really is something that you want to have a good discussion with your loan officer to weigh the pros and cons of whether or not to pay the points. And, you know, a really good rule of thumb to use is if the difference between 1/8% in rate is less than 1/2 point, then you take the lower rate, because if it's less than 1/2 point, it takes less time to recoup the cost. If the difference between 1/8% in rate is greater than 1/2 point, then you want to take the higher rate because it takes so much longer to recoup it. And then the final rule of thumb is get 3 quotes if possible. You want to get a no point quote, the par quote, the cost to get an 1/8% lower rate, and the par plus pricing on a rate that's 1/8% higher. And that way you can compare the cost differences versus the payment savings, and it's a lot easier to do an apples to apples comparison.
All right.
So,
Rick, that was some great information. We had some questions come in if you'd like to take a look at those now.
sure, fire away.
All righty. So the first question we have is, if you don't know how long you're going to be in a home, does it make sense to not use mortgage points?
I think that you probably want to play it safe, and I think you would lean towards not paying points. I mean, if there's any doubt, I would say don't pay the points, because you set yourself up for positive things on down the line. And as you've seen in the examples, at a minimum, it usually takes 4 or 5 years to recoup it. And there's a thing called time value of money that just, if you're not sure that you're going to be in there long term, I would not recommend paying points.
All right, that's some good insight. Here's another question. When you're looking to refinance or purchase, should you always look at the mortgage points?
Oh, absolutely. I mean, absolutely. They're just as important to your cost, the cost of purchasing the house long term, as the sales price. Because in essence, when you're paying points, it increases the cost of the house up front, and you have to be in there long enough to recoup it. Conversely, there are some times when it makes more sense to take the higher rate and give the lender credit, because oftentimes doing that allows you to use your money to put a higher down payment down, and go into a lower tier for mortgage insurance. I mean, that's a different discussion, but you always want to compare your options, and that's why you want to have that in-depth pros and cons discussion with a loan officer that you trust.
Great, thank you. All right, here's another one. Why is it important to get more than one rate quote?
Well, I think we kind of touched on that, because it allows you to do the apples to apples comparison. More than likely, if you call any lender, they're just going to give you the no point quote, and they're going to stop you there. And the pricing on a day-to-day basis, sometimes it favors paying the points. Sometimes it favors doing par plus pricing, but you won't know that if you don't have each one of those to compare.
All right, looks like we have time for one more question. So how about, do points apply to construction loans?
That varies. And usually it's not in terms of points. It's usually in the form of an origination charge, because the construction financing is a short-term loan. Typically, your construction loan is for 6 to 12 months while the house is being built, And then after that, you convert to permanent financing, and that's where the points tend to come into play.
All right, great. All right, thank you, Rick. That was super informative. If you have any other questions that we did not answer for you, please reach out either at mortgages@afma.com or by talking to Rick directly at rmains@afma.com. We're going to go ahead and break here for now, but you can reach us whenever you need to. Please don't hesitate to ask for help. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. You can always register for future presentations and review past presentations at afma.com/webinar. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening for joining us today. We look forward to our next opportunity to assist you.